welcome everyone here to Tech Tuesday. Kevin Hunter with Harry Brelsford, and you can see we have an extra guest on with us today, Brian Livingston from Muscular Portfolios. And Harry, you and Brian go a long ways back, so I'm going to let you introduce Brian, and we'll go from there. Take it away.
Yeah, we do. It could be approaching 25 some odd years. So let me quickly give you the context. Brian and I drafted behind Brian back in the book days, the computer book days. So Brian wrote Windows Secrets that had the desktop audience, and I drafted behind and did secrets for the server side. Brian taught me a few valuable things. First of all, there are desktops than servers in the world. When he got involved in the investment community, he also shared with me that people like money more than Microsoft does. And that's what we're here to talk about today. So good to see you, Brian. It's been a heck of a 25 years.
It's been at least that long. I think I was about 20 when I first met you, right?
There you go. Anyways, I'm excited to learn about money. What's on, guys?
Well, I think that we're seeing a move toward financial technology. And this is going to affect us all. We're all going to be using it. Computers handle our money now. Computers are going to handle our money even more in the future. So this financial technology has the cute little moniker of fintech, and Muscular Portfolios is really fintech that's free. And so one of the great things that we've been able to do is give people access to the same signals that people on Wall Street have had for years, but to give it to them free of charge.
Well, and people like free.
They sure do. The internet is all about free. And I only make money by selling books and by doing seminars. I don't make any money as a financial planner or a wealth manager. I don't want people's money. I won't accept people's money for management. And so we're really showing people that they can do it themselves in less than 15 minutes a month, and they can be their own wealth manager and do just fine.
Brian, I'd like you to expand on that just a little bit, because I publish a lot of information myself online, and which is very helpful for a lot of people in my given sectors. So the fact that you provide all this free information for folks, what do you get out of that personally? Because I understand the professional side of what you're talking about.
Sure. I think information wants to be free. And what I would like is for people to buy the book and for people to attend seminars. And I'm going to be starting a series of webinars at some point in the future, because now we have the ability to spread this information really widely. Harry talked about servers, and now we have servers that can update information constantly whenever the markets are open, and you can display it on our website at muscularportfolios.com with really no cost. Mm-hmm. For servers, no cost to us. It's just handled automatically. The funny thing is that Wall Street puts out millions of numbers every day. It's just a constant flow of data. But we boil it down for people, and they just have to look. In 1 minute, they can see what it is they need to do, turn off the computer, and go out and have fun.
In the spirit of simplification, what are the three bears?
Well, the three bears are the mama bear, the papa bear, and the baby bear. And these names came from the original design of the research project that I started when I realized that people needed to understand fintech or financial technology. That project is called Goldilocks Investing. So what we're looking for, you know that the astronomers are looking for a Goldilocks planet. That's one that's not too hot and all the life is dead, and it's not too cold and all the life is frozen. It's in the middle where life can exist. We are looking for Goldilocks Investing, and that's portfolios that are not too risky, not too tame, but they produce just great gains. So these three portfolios, the mama bear, the papa bear, and the baby bear, use very simple index funds. The papa bear uses more than the mama bear. The papa bear uses 13 different index funds, and the mama bear uses 9. The baby bear only uses 2. We have a flow chart in the book with just 4 questions, and you answer these 4 simple questions, and it tells you which portfolio is right for you. So you don't have to guess. You don't have to juggle and think, which of these 3 should I use? What are your goals? How much risk can you handle emotionally? And that gives you the answer right there. This graph shows one of the portfolios that's exposed in the Muscular Portfolios for free. And it is not something that you have to buy. It's not something that you have to subscribe to. Our newsletter is free. We want people to have this information because it's so cheap now for people to learn these facts. This graph shows the S&P 500 since the high point on February 19th, 2020 through the crash of March 23rd, 2020. The S&P 500 at the bottom of the screen was down more than 33%. But the Papa Bear portfolio is the solid blue line at the top of your screen. And you see that the Papa Bear portfolio was down only 8% on the day that the S&P 500 was down more than 33%. Since that time, this graph goes through May 12th, 2020 on the right side of your screen. You see that the Papa Bear has automatically adjusted its portfolio using very simple low-cost exchange-traded funds, using index funds to right itself, and the Papa Bear portfolio isn't even in a loss right now. It's down negative 1%, which is really a rounding error. The S&P 500 is still down about 15%, and I believe that it's showing sign of weakness. If people can do this for free, and they can do this in 15 minutes a month, I want people to have this information.
That sounds like a win-win deal.
Let's go on to something else about the portfolios. It's really not a good idea to focus on the performance over just a 2 or 3 month period. That's too short. So why am I showing you a graph that's only 2 or 3 months? That's because we want to know how the muscular portfolios work. They keep your losses very small in bear markets. They even have some history of going up slightly during bear markets without any market timing. We don't need market timing. We have a simple computer formula that figures out for you which index funds you should be in this month. So let's look at a complete bear market followed by a complete bull market. This is the shortest period of time that we can get reliable conclusions. You shouldn't believe anybody who picks out their beginning date and picks out their ending date and shows you their returns during that time. That's called cherry picking. What we want is to look at complete bear bull market cycles, because it's not about how much you make during a bull market. It's about how much you keep during a bear market. This chart shows the Mama Bear portfolio from the high point of 2007, when the financial crisis began and the global financial crisis drove the S&P 500 down more than 50%. In that time, the Mama Bear portfolio is actually up a little bit, as you see with that circle. Mm-hmm. The S&P was down more than 55%, and the Mama Bear portfolio was up a few percent. Then you go through the whole long bull market here, and this was one of the longest bull markets in U.S. history, almost 11 years. So the S&P 500 never could catch up with the Mama Bear. So you see the SPY index fund made about 8.7% a year during that whole 13-year period. And the Mama Bear portfolio made 10.9% a year. And the difference in gain is tremendous. The difference between 8.7 and 10.9 doesn't seem like much, but over a 14-year period, you see that if you had a buy and hold of the S&P 500, you would have about $3,100. But with the Mama Bear portfolio, you would have over $4,200. So if you're saving for retirement, or you are in retirement and you want income that you can live on, avoiding these big crashes without market timing is really some skill that investors could learn to use.
Mm-hmm. I think it's excellent.
Now, as an entrepreneur, I call it play not to lose.
That's right. You win by not losing. There are mainstream media and websites and data feeds and all of this that are hypnotizing people with beat the market, beat the market. You don't have to beat the market every year. You don't even have to beat the market every month. That is not the point. The point is to see your money grow over the long term. The S&P 500 crashes 30% or more every 10 years. It has a severe crash of 40% or more every 18 years. And most of us who are listening to this program are going to live another 10 years. So we're going to go through another bear market and another bull market and another bear market. Why have the experience of losing half of your money every 10 years? That is really a waste of time, and it chews up our emotional stability to stay with these investment programs. The graph that I showed you about Mama Bear is produced by an independent authority, and that is etfscreen.com. They have data on all of the exchange-traded funds, all of the index funds, and they go back and use the prices of actual index funds, and that includes the annual fees that the index funds charged, the actual prices you got in the market, the spread between what you buy and what you get when you sell. And so they are independent from me. They can produce this kind of information. Let's go to another source. This source is from touringtrader.com, Turing trader.com. And they are comparing the return of the Mama Bear against the traditional kind of portfolio that most pension funds use, the 60/40 portfolio. That's where you have 60% in stocks all the time, and you have 40% in bonds all the time. That's a very classic, very vanilla kind of a portfolio that a lot of financial institutions and a lot of pension funds use. So it's called the pension model. We can see here that starting from $1,000 at the beginning of 2007, they show also that the 60/40 portfolio was down, looks like here, more than 35%, almost as bad as the S&P 500. But they also show, like ETFscreen.com, that the mama bear went up a little bit during the bear market. That's a tremendous advantage, using a computer formula to let this stuff work itself out instead of you using your guesswork and your intellect and your emotions. Now let's look up here at the end of the bull market, and we see that the pension model only gave you about $2,500 on your $1,000, but the mama bear portfolio gave you $3,700 on your $1,000. And so now we're starting to see financial websites programming in muscular portfolios. You don't have to take my word for it. These other people, they don't work for me. They are starting to include muscular portfolios in their data analysis. It's not just a buy and hold of the S&P 500, which is very, very risky and costs you a lot of money every time it crashes. And you don't have to put up with the old pension model where you have 60% in stocks, usually at the wrong time, and 40% in bonds, usually when you should be invested in something else that is giving you more return. What do you think about that?
Yeah, no, I'm hanging with you. Please continue.
Well, with all of these graphs, not everybody likes graphs. People want more data. And so I'm going to show you something which is my last screen, and it has a lot of numbers on it. So you don't have to read everything that's here. You can look at the Muscular Portfolios newsletter, which is free to subscribe to at muscularportfolios.com. So you don't have to read all these numbers. Just look at the boxes on the bottom of the screen. If you have a very equity-heavy portfolio, you get losses greater than 25%, which most people can't tolerate. So we mentioned that the S&P was down more than 55% in the crash, and the pension model was down almost 35%. The Mama Bear portfolio, as a result, has been ranked in the top 2 of these 10 different portfolios that are tracked by TouringTrader.com. So over the whole bear market, bull market cycle, they're projecting that if you would have just followed the formula, you don't have to think about anything, you don't have to know anybody on Wall Street, you would have made 212%. The S&P 500 only made 178%. And this is something that we want everyone to know for free. Financial technology is going to be a big help. I would never use my own brain to play a game of chess against a grandmaster. That would be foolish. Why wouldn't I use a computer to tell me what the moves I should use against the grandmaster? And we all know that computers have beaten the best grandmasters in the world because they've figured out the game. Well, financial technology has figured out this game. I just want it to be available to people at no charge rather than them paying 1%, 2%, 3% of their life savings every year to a wealth manager on Wall Street, which is a waste of money.
Yeah, absolutely. And I've chatted with you in the past that it is about the fees. A conversation I had with you a few months ago was analogous to a condo timeshare. My mom condo timeshare, she got it early. We enjoy it. She got it in a good baseline. However, there's the fees, the management fees that mysteriously increase over time, and there's sort of the delta that devalue the timeshare condo ownership model. Does that make sense?
Yes, we've found that if you're paying 3% in fees to a financial manager, and they're taking 3% of your money every year, and then they're investing it the same way that you would invest it, after about 23 years, they have as much money in their account as you have left because they have grown their money and not charged themselves any fees. You're paying fees to finance their account. Why not keep that much money, and after 23 years you would have double the amount of money? I'm sure people would like to spend that money.
I like the sounds of that.
Let's talk about personas for investing. So I'm not getting any younger. We'll just leave it at that. And so I have maybe a certain up to investing in my own business and being an entrepreneur and so on. But Brian, we recently spoke with my son, Jeff, who's 24, gainfully employed in the aerospace engineering field, and has a little pocket change, and he's 24 years old. So that's a very different investor persona than myself. Can you speak towards personas?
Sure. I would say there is a myth that young people should take a lot of risk when they're young because they have enough time to make it all back. Well, I find that young people are very sensitive to losing half of the money they've saved. Maybe they have a worse experience than an older person who has seen these market cycles before. When you're 25, 30, you have worked and worked and worked, and maybe you can only save a few dollars a month. And then half of it is gone because the S&P 500 crashed. The majority of businesses in the United States these days put people automatically who are employees into a 401k or a similar tax-deferred account at work. And the majority of people who get those 401k programs from their employers are automatically put into a target date fund. Target date funds are very similar to the 60-40 portfolio, 60% stocks and 40% bonds, but they start with a very high proportion of stocks, almost 100%, and they gradually lower down to 60-40, and then they gradually get lower and lower in stocks. I have shown that that is not even as good as having a 50-50 portfolio for your entire life. And it's definitely not as good as a muscular portfolio, as we've just shown with the results from ETFscreen.com and TuringTrader.com. Why put up with something which never changes, never adapts to the market conditions? Why not use a very simple free thing that whatever happens to the market, it tells you out of these 13 index funds, these 3 are the best bet right now. Those 3 are not always going to perform the best in the next 30 days, but the odds are with you. You want to have the percentages with you. In investing, we never get guarantees. We only get probabilities. So make that work for you, and then I think you'll find that people who are 25, people who are 30, they won't experience these 30, 40, 50% crashes, and they'll never be scarred for life with the memory that they saved and worked hard and lost half of their money.
And go ahead, Kevin, if you have a question. I have one more.
Yeah, I'm very intrigued as a statistician because paying attention to data over a period of time has always made sense to me. And it seems to me that whether it's in business or however somebody's using data, dollars, any kind of numbers for information, that far too often people are looking at far too small a body of information. So one of the smartest things that you've shared on here, from my viewpoint, looking at as a statistician, is that you have to be doing this over a long haul and paying attention to what's going on. So how did you crack the nut? I'm really curious, because clearly your baby bear, mama bear, papa bear is doing better than the so-called vanilla portfolios out there. How did you stumble across this science or the information on how to translate what goes on in the stock market into something that is clear and simple and produces a great result like this?
I started doing this research project in 2012. It's been 8 years now since that beginning. What I found very quickly on is that there is a kind of software called backtesting. You can go back and see what would have happened in history if you had certain assumptions and certain rules about what you would purchase and sell. I found that the gains that you see in the past from backtesting do not repeat. You can't say this strategy made 50% in the past and think it will make 50% in the future. That's not the way it works. The market is too random for that. The market has too much chaos. The future will not be like the past. Now, what does repeat is losses. It's very, very likely, statistically, that a portfolio that's lost 50% of its value in the past will lose 50% of its value in the future. This is almost certain. And what does the S&P 500 do? It loses 30, 40, 50% every 10 years, every 18 years if it's a 40% loss, and that is going to continue. We will be stuck with that for life. So someone has said, the only people who can handle a 100% portfolio of S&P 500 are dead. Well, dead people make great investors because they don't care. They just keep on and keeping on. For people who are alive, I believe that they benefit from something that will cushion them. It's like you wouldn't drive a car without shock absorbers. Muscular portfolios are shock absorbers for your savings. Now, I have on the screen right now the long-term testing back to 1973. This kind of return is tracked by the Quant Simulator. This is a software program developed by Mebane Faber, the co-author of the Ivy Portfolio, a book that came out in, I think, 2008, around the time of the financial crisis. He really showed that you can use asset classes, you can use index funds that are very cheap and very simple, and get good results. So in this diagram, we start with $100, and we see that because of the crashes, the S&P 500 only made about 10% a year from 1973 through 2015. The Mama Bear made about 14%, and the Papa Bear made about 16%. Now remember, I said that gains that you see from testing in the past do not repeat. So I would never say that you're guaranteed to get 14% a year or 16% a year. That's not the way probability works. The market is so random, all we need to know is our money isn't going to crash. We're not going to lose 50% when we are stuck with equities. We are going to grow our money gradually, and that is what helps us outperform the market without market timing and without crashing. I think this kind of thing is really a bit of information that people need to know. The fact is, though, that this graph is using the prices of asset classes in the past, like commodities, like precious metals, like real estate, like equities and bonds. The graphs that I showed previously are based purely on actual, real exchange-traded funds. There's no funny business. It's the prices that you would have got if you would have bought those things exactly at the end of the month, just like it says, and it subtracts the expenses that the funds were charging, and it subtracts the spreads that the market makers were charging you at the time. This graph that I'm showing you now is theoretical based on index funds back to 1973, but I'm very, very, very proud and astonished, actually, at how well the Mama Bear and the Papa Bear have done when measured today by actual authorities who are using actual exchange-traded fund prices.
That's excellent.
So I actually have two questions now. The first one is more on the humor level that I bet you're the most popular person at a holiday party. And what I mean by that is when a doctor goes to a holiday party, we all naturally gravitate over to the doctor and go, "Hey, doc, my knee's hurting. What should I do?" And doctors hate that. They hate going to holiday parties and giving advice. So I'm assuming your popularity is the same as a doctor at parties because people want to ask you for advice, but you've been very careful to emphasize that you're not offering advice. You're not a stockbroker. You're not actually offering individual advice. Is that correct?
That's right. I am an investigative journalist. I have contributed to MarketWatch.com and to StockCharts.com, as well as in the past, as you noted before, I wrote 11 books that were titled Windows Secrets This and Windows Secrets That. Now, I wanted to say, as a journalist, I won't accept money for management. I don't take any fees for managing anybody's money. So I try not to have a conflict of interest here. But I want people to understand is that there are 4 kinds of portfolios, and really we want to stay away from 3 out of the 4. So you have high-risk portfolios, which are even riskier than the stock market, like hedge funds. They use borrowed money to leverage their portfolio into a much riskier kind of holdings. That's a high-risk portfolio. You have a second kind of portfolio called a lazy portfolio, which is like the 60-40 pension model. You stay with the same percentage of stocks and bonds for your whole life. Maybe you lower the stock portion a little bit when you get older. That's the second kind of portfolio. The third kind of portfolio is a muscular portfolio. That is a diversified portfolio where you don't make as much money as the S&P 500 during a bull market, but you do so much better than the S&P 500 during a bear market that you are able to get market-like returns or better over the whole bear bull market cycle. Now, you may say, well, Brian, you said there were 4 kinds of portfolios. The 4th kind of portfolio is what we call a Yeti portfolio, and that's one that beats the S&P 500 on the months that it's going up, and it beats the S&P 500 on months when it's going down. It's a Yeti portfolio because it's a myth. That kind of portfolio cannot exist. You would think that would be great. Let's have the Yeti portfolio, but any portfolio that beat the S&P 500 every month on the way up and on the way down would immediately be programmed into all of the supercomputers around the world, and the traders would be trying to take advantage of it, and the phenomenon would disappear. So, muscular portfolios are something that are so simple that no hedge fund could possibly sell it to a client. The client can do it much more easily himself or herself. So they'll keep selling Yeti portfolios. We can do better. We can beat the S&P 500 every month, and they're just a fable. They're just a myth.
Final question I have, and again, I always like to use storytelling. So one of my early readers who became a friend, Bob Hood out of Chicago, is your kind of guy. He told me, Harry, if you're focusing on individual stocks, because there's this natural tendency to say, psst, psst, Fortinet is coming out with a new security product, buy Fortinet. And if you focus on individual stocks, he said, Harry, you're going to have to work till you're 80 being a Walmart greeter. And I don't know if you want to speak to that.
Well, we all think that we are geniuses. We all think that we're psychic. And the stock markets have existed for hundreds of years because they take advantage of the way that we human beings are overconfident, that we ascribe magical abilities to our own thinking process. That is something that we just have to give up. We are not psychic. We are not going to guess the right way that stocks are going to jump up and down. And we need to accept that a computer can pick these things out much better than we can. I don't want to pay somebody 1%, 2%, 3% to use their computer. You can do it on your phone. So that's so simple and so cheap that we can give it away now. Think of all the things that we used to pay money for. It used to cost $2 a minute to call your grandmother on the other side of the country on the phone. And now cell phones make it free to make phone calls anywhere you want. So now we have that with financial technology. We use computers to show people the information for free because the computer isn't charging us minimum wage. We have to feed it electricity, but that's about it.
All right. Thank you, Brian. You've answered questions.
All right. Well, that's going to be a wrap here on Tech Tuesday. Thanks to Brian Livingston for joining us here on the show. Make sure you get the book, Muscular Portfolios, and you can visit the website that is also muscularportfolios.com. Is that correct?
That's right.
Here's some of his old books, Vista Secrets. So, Brian, thanks for doing good work in both the financial and technology areas. Thank you very much.
You're welcome, Harry.
All right, Kevin Hunter, Harry Brelsford, and our special guest, Brian Livingston. Thanks, everyone, for joining us here on Tech Tuesday. Till next time, take care.